So last week, I was listening to two CEOs on an earnings call, and I see the same pattern I've seen over and over again, or what I think of as bad capital allocation. Hi, my name is Gary Mishers. I'm the managing partner and chief investment officer of Silver Ring Value Partners. I also teach the value investing seminar at the FW Olin Graduate School of Business. So these two CEOs are actually two of the best CEOs in the group of companies that I follow. They're great operators. They've done a good job managing the business for a while. No complaints there. But here's what they've said. They said, well, now that they feel much better about near-term business prospects, they're going to start buying back stock. By the way, they didn't buy stock 6 months ago or 12 months ago when it was much cheaper. So, what's wrong with this picture? Well, first of all, nowhere in their statement about buying back stock was there a comparison in price and value. That would be an intelligent way of deciding whether to buy back stock, as if it's below intrinsic value, you buy it back. If it's not, you don't. Pretty simple. Instead, they're using how their gut feel feels at the moment about near-term business prospects. But guess what? They might feel great about the next 2 quarters or a year, and they might have felt terribly a year ago about those same time frames. But it might be all reflected in the stock, or more than reflected, or less. So it's a silly way to make capital allocation decisions. And here's the bigger point. I really don't think the average CEO has the experience to make that decision. Now, you might say, well, how come? And the answer is simple. They didn't become CEO because they're amazing capital allocators. They became CEOs hopefully because they were great managers. And managing a business and people is not the same as making investment decisions with excess capital. Number two is, there you might say, well, gee, but it's really not them. They're just suggesting a capital allocation policy to the board of directors, and that board decides. That's a nice theory of how maybe things would work, but that's not how things work. There's two reasons. One is, in terms of large public companies, most directors don't have much skin in the game. They have some stock they got usually as part of payment for being on the board, and they get a nice, very juicy, 200, 300K a year payment for being on the board. There might be a retired executive, an active executive, or someone with social standing where they bring either real or perceived, perspective or reputation to the board, right? That's kind of why they're there. They're not necessarily great capital allocators themselves, and they just don't have enough skin in the game. Think about this. Do they? What do they care about? Keeping their board seat, keeping in good standing with their fellow board members and CEOs, being invited to be on other boards, if that's their thing, which for many of them it is, or making the very best capital allocation decisions and maximizing the value of the stock. It's a no-brainer. They're going to not rock the boat 99% of the time. So, what's the solution? The solution is think about how you would do this in a private business. Think about it this way. You and two friends get together and you buy a private company. You hire a manager to run it, and that business generates some excess capital, some free cash flow. Well, would you really just delegate the decision of what to do with your money and your two friends' money to the manager? No, the manager might be great at running the business. What does he know about how you want to spend your money, invest it, and so forth? They don't necessarily. Would you hire some board of kind of people with nice resumes to be your representatives to then take that cash flow and invest it for you? You would be crazy to do that unless you were very lucky in who you were able to bring in on the board. Most of the time, you and your two friends would tell the CEO, "Thank you. You did your job. Keep doing a great job. Give me the excess money right here. Put the cash flow over here." And the three of us, who are the owners, are going to decide how we want to allocate that, whether it's to just return it in the form of a dividend or do something else with it, right? And maybe the CEO would make a suggestion, and that's fine, but the three of you would be the deciding, actors in that decision. And that's the way it should be because you own the business. That's what you have the most at stake. So that principal agent problem in public companies is a big deal because in my 20 years of experience, I have seen this time and time again where good managers who just don't have either the right wiring to make tough but good capital allocation calls, or just don't have the experience, they end up making subpar decisions with other people's money. And it is other people's money. It's not their money. I mean, they might own a little bit of the company. That percentage of it might be theirs, but the rest isn't. So it's a problem. I'm a big fan of capitalism. I'm a big fan of public market capitalism, but I think that's an issue. And I think the only way it maybe gets better is if people speak up and try to make a difference. And I hope other people, notice and make things a little bit better on the margin. I hope this was helpful to you. If it has been, please hit like, subscribe to the YouTube channel, and I'll see you in the next video.